A very good afternoon to our viewers of VC World, which is the venture capital community of PW Business World. We have with us today the managing partner of Bay Capital, Keyur Majmudar, who brings with himself 28 years of financial experience covering investment banking, equity advisory, and fund management. Prior to Bay Capital, he was with Kotak Mahindra Group for over 11 years. Keyur is also involved with a few non-profit organizations in an advisory capacity and sits on the board of Foundation for Rebuilding Childhood, which is the Indian affiliate of the Global Fund for Children. The Bay Capital India Fund invests exclusively in publicly traded securities in India and has been investing in several companies at their pre-IPO stage for nearly 2 decades now. Thank you so much for joining us today.
Thank you, Anisha. Great to be here. Thank you.
Bay Capital has invested over 1.2 billion across 70 to 80 investments in India. Can you give us an overview of the number of companies and the typical capital size that is deployed by the fund?
Yeah, Anisha. So thanks for that. So as a firm, we've been around for close to 16 years now. As you said at the top of your introduction, the three senior partners at the firm have all spent time previously at the Kotak Mahindra Group. And as individuals, we've known each other for many years. As a firm, since 2007, we've been fortunate to invest across a gamut of opportunities. And although today, as we speak, we are primarily public market investors, we've also invested across the private space, the early stage space, and pretty much across the stage curve, if you will. So without getting into any specific numbers, it's broadly in the ballpark of the number that you mentioned. Given our vintage of investing, as a firm over the last 16 or 17 years, certainly, we have, invested in more than 70 or 80 different kinds of businesses. Our current portfolio, of course, that we hold is through our Bay Capital India Fund, which is a concentrated portfolio of names. So, in the fund, we don't own more than 20 names, 20 businesses. As we speak today, actually, we own 19 names. So in that sense, the fund is fairly concentrated. Investment philosophy-wise, while we are sort of sector agnostic or market cap agnostic, we have a preference for consumer-facing businesses because we think that that's where the larger opportunity set in India lies. And through our investing history as well, our primary focus area has been, consumer-facing businesses. So, consumer-facing does not necessarily mean only consumer staples. That manifests in several different, segments. And more recently, as you mentioned, we've started to invest over the last couple of years for sure in some of the late-stage businesses as well. Some of them have gone on to get listed. Notably Policy Bazaar, which is PB FinTech, and more recently Delhivery. And I'm sure as part of the conversation, we'll get to talk a little bit about that. And we have a couple more that we think will list between now and the end of the year. So, that's pretty much what it is. In terms of check size, again, it depends on the nature of the opportunity, but ballpark wise, it is in the range of, 15 to 20 million. That's sort of the investment check, if you will, that we put down for any of our investments, Anisha.
Since the pandemic, of course, we've seen the acceleration of digitization in the country. And of course, technology has had an exponential growth since as an impact of the pandemic as well. So do you think that has impacted the investment strategies of Bay Capital, if at all? And if so, then how?
Yeah, so I would say that it has certainly impacted and impacted positively. So we've always been, excited by, the digital transformation that has been unfolding. And, as we think about it as investors, right, the digital transformation is not something that's 1 year or 2 years old. It can be traced back 7 or 8 years, and there are 4 or 5 building blocks as we think about it, right? So when you put the Jam Trinity, when you think about the Jan Dhan, Aadhaar, mobile linkages, and the direct benefit transfer, that ecosystem, when you put that together with the India stack, which made eKYC and the like very, very smooth and easy, and enabled many other applications to be built on top of the stack. And then when you put that together with the explosion of UPI and demonetization, and finally the launch of Geo, which has really brought down mobile prices, as we all know, right? So the statistics that everyone talks about is that India is the largest consumer per capita of data in the world, and all of that data of 14 or 15 GB per capita is happening at the lowest cost. And I think that has democratized information, that has democratized access to information, and that has opened up a plethora of opportunities. So the entire digital journey of India as well has been a journey over 7 or 8 or 9 years. And as you rightly pointed out, all of that sort of culminated and lifted off and accelerated as a result of the pandemic, as more and more consumers and customers shifted to consuming and experiencing brands and services online, right? And I think that is a structural shift which is not going to decelerate. And I think that has very, very profound implications for a whole range of businesses, certainly on the consumer internet side. So valuations aside and all of the excesses aside that we've seen in the last maybe 12 or 14 months, I think what is undeniable is the fact that this digital transformation is structural, it is permanent, it is here to stay, and India is pretty much advanced in its journey in the same way that we saw this whole digital transformation playing out in China or the US. So, in many ways, India is perhaps 6 or 7 years behind China, and this explosion in e-commerce, this explosion in all of the other activities that we're seeing in India is something that's permanent. And obviously for us as investors, it opens up a whole gamut of investment opportunities. And certainly from our side, we have been very, very cognizant of what has been happening. One of our investee companies in the listed space, of course, has been InfoEdge, which is India's first listed classifieds internet business, and we've owned it for now 5 or 6 years. And as we have remained invested in the business, we also obviously had a line of sight and a deep understanding of 2 of their very, very successful businesses which they own, right? Which is PB Fintech Policy Bazaar and Zomato, which now have gone on to get listed last year. So we have been sort of watching this space for a while. We think we have a very, very good understanding of the digital ecosystem and the consumer internet opportunity in India, and certainly we think that the next 7 or 10 years is going to result in many of these large sort of technology or consumer internet businesses becoming very, very large from here, notwithstanding, as I said, valuations or any near-term concerns. So what's going to happen in 4, 6, 8, 9 months, we sort of don't know, but we do believe that this digital transformation is permanent, and over the next decade you are going to see many of these large technology businesses getting even bigger and even more dominant in the segments that they operate in. And therefore, again, as I said, for us as investors, that has very significant and profound implications. And certainly we are positioned for that in the fund.
So several of the investees of Bay Capital has been market-bound companies, especially at their pre-IPO stages. So can you tell us why the company chose to invest in companies, in investees who are at this pre-IPO stage? And my other question, a follow-up question to your previous answer is that as we were just discussing, that India is now maturing towards that mature tech landscape for India. Is the company also looking at investing at any pre-IPO, like at a prior IPO stage in India at this point?
Yeah, so over the last maybe 14, 16, 17 months, we have invested in several of these late stage businesses. As I mentioned, two of them have gone on to get listed. Subsequently, the most recent was Delhivery. So we had invested in Delhivery when it was private last year. And of course, we had invested in PB FinTech, pretty much in January or February of 2021. And obviously, subsequently, it got listed in November last year. So that is a space that we are open to invest in. As I said, our fund is primarily a public market fund, so that's the core playing field for us. But we are certainly open to very, very select opportunities as they come up on the late stage side. And I think that the rationale for us for looking at some of these late stage businesses was the fact that when we were evaluating them, for us it was really about our ability to access these businesses and to be able to get on their cap tables. And it was in our mind, an entry point at a valuation that we were comfortable with over a 5-year or 7-year period, right? Because for us as investors, there are two things that are of primary importance. One is just our investment horizon, because we choose to invest for 7 or 10 years. So when we were investing in these late stage businesses, or when we are investing in the public markets also, we're not looking to flip in and flip out and trade very actively. So when we've looked at the private names, for us it was about investing when they were private, seeing the journey to them becoming publicly listed, and then continuing to hold on to them for the next 5 or 7 or 10 years, because we think that even after they've got publicly listed, their journey for growth and the runway for the business being built out is very, very significant. So it's, that's really what it was. And to our mind, the valuation and entry points at which we were able to enter also gave us a huge amount of comfort. So despite all of the unfortunate carnage that you're seeing, where all of these technology names have got pretty much decimated, we think that we have been very, very careful in being very selective about what we've invested in. We are anchored to businesses where we have a very good line of sight on their path to profitability. And we think we've invested in businesses which don't need a lot of incremental capital. These businesses don't need to fund every stage of their growth by raising more and more money. Each of these businesses has fairly fortified balance sheets. They have cash on their books, which obviously puts them in an enviable position. And perhaps most importantly, each of the businesses that we've certainly invested in are very strong and dominant players in the segments that they operate in. So, our thinking, our philosophy, and in our investing style, we were very, very, careful and selective in terms of the businesses that we wanted to, invest in. And as you can imagine, there were many businesses that were out there, but we've chosen not to invest in them, and I think that has held us in good stead. So, that's really, how we thought about investing in the late stage. We're open to it. But again, it has to be very selective. It has to pass through our filters, and it has obviously to make sense from a valuation standpoint. And for us, it has to make sense as a 7 or 10-year investment, because we're not looking to flip in and flip out at the time of listing. That's not who we are.
Could you give us a sense of how the investment pipeline for for this year is looking for Bay Capital, and if you're looking at investing in any specific sector?
Yeah, so for us, actually, given what has happened in the public markets, we just think that there are a whole bunch of opportunities which are out there in the public markets, as prices have corrected between 20 and 50% in some cases, and in that sense, it works to our advantages because businesses or names or companies that we would have wanted to invest in. Again, I'm talking from the public market standpoint. Which were trading at what to our mind was, not such attractive valuation, those have corrected significantly, and therefore those are becoming that much more exciting for us. So our focus right now is on the public market side, because we see a whole bunch of opportunities there. And as I said, these are businesses, which are typically consumer facing, and which have certain attributes which we look out for, which we think are high quality, right? Which is really primarily throwing up a lot of free cash flow, great transparent governance standards, dominant players in the segments that they operate in, and not really requiring too much of incremental capital to grow and scale as they move along. So the focus is really on the public side, because we think that there are a whole plethora of opportunities there, and I think it straddles sectors, to be honest with you, Anisha. So we're not focused on any one particular sector. We're seeing a whole range of opportunities across. If you were to sort of slice and dice and dissect our portfolio, we're really trying to capture 3 or 4 broad themes, right? So first and foremost is really the digitization and the digital opportunity, and we've sort of talked about that. The second is really the financialization theme that's happening, right? Which is that a larger proportion of incremental household savings are now going into financial assets, right? Earlier, of course, Indians historically would invest in real estate or gold as traditional stores of value, and now there's a whole bunch of financialization that's happening. And so that again has implications on several businesses which are out there. So financialization is the other theme. Consumption, of course, has been historically our forte. So we continue to like that. India is one of those rare, economies where the power of the domestic, consumer is so strong and powerful, and which will certainly hold it in good stead. So these are the 3, broad buckets, and then we are also sort of looking at select names which, cater to the global market, right? So the outsourcing theme, and when we're saying outsourcing, it need not necessarily mean, technology services. There are a whole bunch of other high quality businesses where, we can express that view of, high quality companies catering to a larger global marketplace. So our portfolio is really a composition of these 3 or 4 themes. And I think, Anisha, just to add a quick thing as a corollary to this is also that, while we invest in these 3 or 4, broad pockets of opportunities, there are a whole bunch of things which we don't invest in. And I think in the investing sphere, what you don't invest in is as important as what you will invest in. And I think that has certainly held us in good stead, through every market cycle, and this one also.
So if you could also discuss a little bit about how the investing strategy of Bay Capital has evolved. As of course, we were just discussing that it is very important to know what to not invest in as well. And the fact that Bay Capital has consciously chosen to invest in very specific kind of sectors, very specific kind of companies over the past many years. So if you could discuss with us possibly how the investment strategy has evolved and what the exit strategy Bay Capital normally looks like.
Again, as I said, we've been sort of fortunate that we've got to invest across the stage curve, if you will, right? So, we've done public markets, we've done private, we've in the past done some early stage investing as well, right? And I think that has given us a good, line of sight onto, how business can scale and evolve. And, much of what we are doing today is also a function of some of the mistakes that we've made in the past, right? And with any investor, you make the mistakes, you learn from them, and you try and ensure that you don't sort of end up repeating those. And a case in point is certainly the infrastructure kind of names, right? So those are sort of businesses where as a firm we will not look to invest in, right? Because they come with a whole bunch of complications and complexities and so on and so forth. So no matter how exciting the top down view might be on the infrastructure opportunity in India, whether it's roads, bridges, ports, airports, highways, etc., etc. Those are businesses that we sort of choose to stay away from. Similarly with real estate as well, although the sector has seen a lot of cleaning up and a lot of formalization, if you will. That's again a segment or a pocket that we typically do not look at. So so I think that's really where we are. We are agnostic in terms of what we will invest in. There are certain attributes that we look for from a business, both be it private or on the public side. And I've described them to you, right? So businesses which typically tend to throw up a lot of free cash flow, or in the case of some of these technology businesses, they already have a lot of cash on their balance sheet, and they don't need to raise incremental capital every few months or every few quarters just to fuel the next phase of growth. We like businesses where there is no question mark on governance or transparency standards. We like businesses where these companies have already emerged to become dominant competitive players in the segments that they operate in. So most of our portfolio businesses will be the number 2 or number 1 player in the segment that it operates in. So we like these businesses which are large, dominant players. And as the larger India story unfolds, right, we just think that the big businesses will continue to getting bigger. And certainly our portfolios is positioned for that. So be it public, be it private, as long as the business sort of meets with these fundamental characteristics, we are okay to look at them. We don't want to look at a business which is the 7th player in the segment that it operates in. We don't want to operate or invest in businesses which operate in very cluttered segments, right, where there is very little differentiation that is possible to do. Certainly, we think, for example, in the fintech space today, just to take an illustration, there are several segments, but there is very little differentiation that's possible, and it just comes across as a very cluttered space. So we choose not to invest in in spaces where there's too many players with very little differentiation. And as long as these broad characteristics sort of stand out, we will look at them and then do our deep and detailed work, and then frame our investment thesis, and then end up buying the names. Again, from an exit perspective, as I said, our primary focus is on public market names, and those are obviously very, very liquid. Our typical holding period is north of 5 years, so we're very happy to own a name for 7 or 8 or 9 years. And so for us, unless our fundamental thesis in any business has changed, and changed very, very dramatically, or that valuations have gone very, very significantly away from the long-term growth and earnings trajectory, we don't look to sort of exit. We choose to remain invested, and we go through the up and down, because for us, we just want to buy and hold businesses and allow for compounding returns to be generated over an extended period of time, Nisha. So that's really how we think about things.
For nearly 2 decades, Bay Capital has been fostering and investing in very good quality marquee Indian businesses. So as one of the key leaders of the firm, what would be your advice to founders or promoters on building long-term businesses?
Yeah, so that's something that we think about, certainly, for ourselves as well as for the businesses that we invest in. And I think the key thing, cliched as it sounds, is just to have that long-term orientation, right? And I think that's an important starting point, because unless one has that long-term view, it's very difficult to sort of build out. That said, it's also very, very important to think about durability, to think about something that endures, right? And I think as certainly our firm, we've been around for 16 years. We've gone through different market cycles, and at certain points of times it's about surviving, right? And so there will be challenging times. There will be times, certainly now in the startup ecosystem, it's really about just being out there and surviving, and putting your head down, and focusing on the business, focusing on profitability, not getting swayed by distractions, and just continuing to execute. So I think the focus on long term, and the focus on building that's something that endures, right? And you might think about it as legacy, right? There are so many businesses globally that are out there which have far outlived their founders, right? You can take the example of JP Morgan, right? JP Morgan built something, he's long gone, but the institution and the legacy continues and endures, right? And if entrepreneurs and founders and others can think about businesses in that way, that these are brands and businesses that will endure long after individuals are not there, then you truly build something, you truly build a legacy, right? And I think along with that also comes the thinking to adapt and evolve, which I believe, Anisha, is very, very important, right? I think this continuous evolution, if you will, that needs to happen, because times are changing, environment changes very, very rapidly, and one has to be relevant at all times to your customer set. So you have to build in adaptability and agility into how you function. And while that is possible, certainly when one is small, building that culture of agility as you scale and grow and become larger is something that is also very, very important to keep in mind. And I think businesses that adapted and were agile actually benefited the most through the pandemic, right? Because literally overnight you had just things just shutting down, right? And you just had to figure out how to execute, and how to function. And I think the businesses that ended up being agile and adapting to that environment rapidly certainly were the outsized gainers. So I think those are sort of some of the broad things. And I think one aspect that perhaps maybe doesn't get spoken about is just culture of organizations, and what is the kind of firm, what is the kind of organization that you want to build. And if there is one thing, Anisha, that the pandemic has taught us, I think empathy is something that's underappreciated. And I think while business and everything is good, if there's a culture of empathy that can be ingrained into businesses, then I think those businesses will certainly be able to foster and grow, and leave a legacy of a particular kind. And I think that's an important aspect as well. So while you chase growth and you chase profitability, it's also to build in that empathy towards your employees, or towards your larger ecosystem, towards your investors, if you're a consumer business, towards your suppliers, your distributors, so on and so forth. And I think that's an important thing to have. That defines, the culture defines who you are, and what is the legacy that you live, Nisha.
Thank you so much for joining us today. I'm sure our viewers are going to find the conversation very insightful and very engaging. And just on that note, I'd like to mention that, as we were just discussing, that transparency and in the governance and the culture of an organization is so significant on the typical kind of business models and the business that entrepreneurs in India are building. And of course, also the significance currently of the accelerated growth of digitization in India is something that entrepreneurs need to focus on, promoters of long-term businesses need to focus on. So certainly our viewers are going to find this conversation very insightful. Thank you so much for joining us from Business World. And we look forward to having with you again with us.
Not at all, Anisha. Thank you for for giving me this opportunity to speak with you and the larger ecosystem out there. And hopefully we'll get to have more of these conversations, because there's so much more to talk about in what's happening in India and the world. So look forward to that, and thanks again for the opportunity.